You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. If you trade options, you want to be smart about every decision. So why not choose the smartest platform for your trades? At public.com, you can view upcoming earnings dates directly in the options chain. You can queue and execute multiple orders simultaneously. Easily view contract performance over time. And if you have a question about any stock, you can ask Alpha, their AI for investors. But want to know the smartest part of trading options on Public? Earning rebates on every single contract traded. No other platform provides options trading rebates, and they reduce your trading costs to less than $0 per trade. So, make the smart move and switch to Public.com, the only options trading platform where you can earn rebates on every single contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means we are back once again. Time to talk a little bit of options education. Yes, it's time once again for Options Boot Camp, the premier options educational program. My name, of course, Mark Longo from the optionsinsider.com. Hope you're having a good trading week. It's a intriguing one, to say the least. A lot popping off on the micro in terms of individual names and earnings, and on the macro, the global, the geopolitical front. A lot popping off out there, listeners. So our tagline at the end of the show, more important than ever, stay safe out there, stay frosty. We need you out there listening to the show at the end of the day. If you're not there listening, what's the point? Dan and I are just talking into microphones. Again, if you're having a good time listening to this show, anything else on the network, throw a like, a star, a comment. All that does help new people continue to discover the content. Just like this week, we have Aiden saying, great show, wouldn't mind more EPs. Well, yeah, it's challenging to get one out a week for this show, quite frankly, Aiden. Luckily for you, we have a full network of other shows out there, nearly a dozen shows, so you can usually get 1 to 2 shows a day from us on the network. So if you need more, that's why I've always said, make sure you're subscribing to the full network. There's 17 plus years of content for you, usually a couple of shows coming at you a day. This week in futures, options, crypto, vol views, all sorts of fun. The option block twice a week. Just did a live one from the SIBO on Monday. That was really fun. Check that out if you are so inclined, with some special guests. All sorts of fun there, listeners. So if you like what you hear, again, join Aiden and throw in a like, a star, a comment. And of course, if you want to go above and beyond, you want even more content. Let's say you wanted to get access to our awesome, far-reaching pro Q&A yesterday with our buddy, the Last Emperor from Fidelity. You want to join us on Friday for a little bit of options oddities, live streams, everything else, theoptionsinsider.com/pro. So if you want the more EPs that Aiden and other people want, that's another good place to go. As we go around the horn, see who's joining us today, I am pleased to welcome back once again. His streak is now unbroken here for a decade or so. He is the black-headed one, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. How go things in P-Town, sir?
Hey, man. Things are going great over here. Can't complain. And just here watching the volatility play out.
Yeah, a little bit of fun playing out there, which leads us right into our topic this week. It is time for some options drills.
Howlin' Boots! Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes,
sir! All right, everybody, welcome to the options drill segment. This is where we go a little bit above and beyond the basic training, explore some options concepts or techniques, explain how we utilize them or perhaps don't utilize them out there in the markets. And as Dan alluded to, a little bit popping off out there in the markets today, and a lot popping off again this weekend, which brought me around once again to a very thorny subject for many options traders out there and for just market participants in general. It is the subject of weekend risk. Dan, when I say this loaded term, that is weekend risk, what leaps to mind? Let's play a little Dan word association game. What leaps to mind, sir, when I say the term weekend risk?
Well, that is, you think of overnight risk, just like gap risk, like, what happens if some political event or something happens overnight? Well, the weekend has 3 days for that kind of thing to happen. Overnights 3 times in a row. And, you never know in this crazy world. So weekend risk has always been an important thing and kind of feels like it's more of an important thing nowadays.
Yeah, ever since the onset of the pandemic, we've been saying there is quite literal weekend risk, seemingly almost every weekend. We have seen it playing out quite literally in front of our eyes the last 2 weekends. We are, of course, recording this in mid to late July here, 2024. Listen, I know a lot of people come in many months, if not years, down the road on this show. So let's give you some frame of reference for where we are recording this now. We're coming hot off the heels of Biden, of course, the sitting U.S. president, stepping down at least from seeking the nomination, not stepping down from running the country. So that was a whole heck of a lot of weekend risk playing out in front of us. The week before it, of course, we saw an attempted and very, very close assassination attempt on the former president, Donald Trump. So 2 weekends now, back to back, we've had major weekend risk playing out in front of our eyes out there. So if you needed some more convincing, if you were sitting on the sideline to saying, I'm okay riding this turbulence throughout the weekend, maybe these last few weekends have caused you to sit up and take notice. Obviously, weekend risk is problematic. As Dan pointed out, it's overnight risk times 3. And of course, the major problem for a lot of people is really most of the major assets that you trade are going to be closed when all this fun is playing out. So if it happened during the week, you could probably take some aggressive action. If you thought maybe the worm was really turning, you could bail on things, you could hedge, you could do a lot of different things. On the weekend, you can kind of just sit there and twiddle your thumbs and watch your assets erode. Now, obviously, there's exceptions to that. Futures trade on a much more active schedule. Crypto is obviously 24/7, so there's going to be exceptions to this. But for a lot of you out there listening to this, you're trading equities and equity indexes and trading options on them, or perhaps hoping to. So for a lot of you, the markets you're mostly engaging with are closed. So this has been a problem for a lot of people for a long time. Dan, maybe we'll start there. I have a few ideas on what people can do, but people have obviously come to you over the years at MTM, and they say, Professore P, I have this weekend risk thing. It's driving me crazy. What can I do? What is usually your first recommendation for those folks?
Oh, boy. We only have one episode to talk about this.
I'll give you 6 minutes. Go. Now, take your time, sir. We got a lot of time to sink into this one.
All right, I'll talk fast. I should have had that Red Bull I was thinking about. The first thing in order to control weekend risk is not to have it to begin with. In trading, what we do as traders is we take on risk seeking profit. But controlled risk is always the name of the game. Going and just selling a boatload of naked puts that you're hoping to skate on might not be the best position to be carrying through a weekend, especially in this climate. Things like put spreads, where there's limited risk, might be a little smarter. I mean, it depends on what you're trying to accomplish. We've talked a lot about that. So, I mean, I'll just do this iteratively so that you can kind of chime in too. But I would say that step one is making sure that you have a controlled risk position on going into the weekend to begin with.
Yes, controlling the risk. There's a lot of ways you can go about that. I mean, the obvious one, we'll get it out of the way now. You're worried about something. This past weekend, towards the end of the week, there was a lot of concern about what might happen over the weekend. That could have been too much for you. So the obvious suggestion right there is you can close or scale back your positions. That's step one for all of this stuff. Now, there's pros and cons, obviously, to that. Now, if you did that, of course, you obviously missed the rip-up that happened on Monday as a result. Also, there's tax considerations for a lot of you out there. If you're sitting on some gains, you may not want to bail on everything and take the big tax hit out there. So that's really not a solution for most people. I throw it out there because if you're having a hard time sleeping, whatever the case may be, getting the heck out of Dodge or scaling back, position sizing is another way to approach it out there. But that's not going to be suitable, I know, for a lot of you out there. Dan, the intriguing thing that I've heard a lot of people talking about these days, and one of the reasons, we hear a lot of retail piling into these products now. But one of the reasons, whenever I talk to some seasoned derivatives folks who've been trading options for, decades, and they come to me and they're just effusive with praise for the 0-day options. I always ask them why. Why do you love these things so much? And the number one response I typically get is there's no overnight risk. And obviously, as a result, no weekend risk. Their position is flat at the end of the day. So for them, they're living the old market-making dream. When you and I were on the trading floor, the goal was to go home flat every day. It never really happened. You always had some residual gamma or vega or something on. But you shot for that every day. Now with 0-day, you can effectively do that. So what are your thoughts on using these near-dated contracts as a bit of an end run around overnight or indeed weekend risk, sir?
Mark, it's like you could read my freaking mind. That is exactly what I wanted to talk about next. And that's why we recently launched our 0-day hero, which is a 0 DTE scanner, especially on the indexes, which is really what we're going to be caring a lot about when it comes to weekend risk. But yeah, I have been preaching to the choir and anybody else who would listen about how 0 DTE options eliminate overnight and weekend risk. So yeah, that is slowly becoming our most popular class/scanner.
Would you say for you that's one of your primary drivers into 0-day is just that complete lack of overnight risk?
Absolutely. I mean, it's such a gigantic advantage. I mean, look, if you want to carry a position every day, that's fine. Start at the beginning of the day and get out of it, that overnight risk, and put it on again tomorrow morning. Like, you can still have a position every day, but you're just so much more nimble and your risk is massively minimized.
That's the interesting thing about recording this show now versus doing it even a few years ago. A few years ago, we would have had far fewer options, pun intended, in terms of what we could recommend on the near-dated front. You can obviously go crazy with some 5-minute binaries, but outside of that, the 0-day complex wasn't really a thing. You could trade options on expiration day in the weeklies, obviously, but that was really about it. Obviously, the weeklies were there, and that is also an option. I can hear a lot of you out there right now saying, well, I'm more of a premium harvester. The 0-day isn't really doing it for me. You could still obviously play in the weeklies. A lot of names are pretty active. You could still get some decent covered calls and short puts in on a weekly basis. And then those obviously expire at the end of the week. So those are going to help you avoid that weekend risk problem as well. So I would say step one for a lot of you out there who are concerned about this, you might bristle at this, but maybe migrating some of your liquidity into products that don't have the weekend risk is step one. So, Dan, what are your thoughts on that? Just making that the first step, migrating some of your liquidity into products that take that worry out of your hands, sir.
Oh, yeah. Yeah. Very, very strongly recommend that. Like, again, especially now, like you look at the election, there was, I don't know, some degree of uncertainty as to what would happen there. It seemed like maybe things were solidifying one way or another, but now there's a whole new candidates and there's a whole new, who's the vice president. We don't know really anything about policies. Like, I think that there's, proposed policies of Harris. And so if for sure she's even going to be the candidate, like there's a lot of uncertainty right now, and having 3 days, like that news cycle never sleeps. So 3 days to not be able to trade, big deal.
Yeah, just a lot to unpack there. I do think also post-pandemic for a lot of people, just the ability to sleep at night has become more valuable for a lot of them. There's other stresses, other risks going on in society. They maybe don't need a little bit extra in their portfolio. So a lot of people maybe in the past wouldn't have been intrigued by a product like this are now starting to gravitate towards it for that exact reason. They can sleep at night, and that's a valuable thing for a lot of people out there. Shouldn't be undersold. Let's keep rolling out here now. Let's get to some maybe more traditional ways people have tried to tackle this problem in the past. Pre-0 day bonanza, people were still tilting at this windmill. They continue to do so today outside of 0 day. Some of the other attempts people have made at this, obviously. And now, again, as Dan mentioned, we're focusing mostly on the broad portfolio stuff. So you're talking your broad indexes. You could apply a lot of this to single names as well, but it's obviously going to vary depending on the name you're talking about and how the skew looks out there and what the vol is and liquidity, all those other things. So we're mostly talking about broad indexes, but you can apply a lot of this to single names, at least some of the larger ones. But so a lot of people looking at weekend risk, they don't want to dump, let's say, their SPY or SPX portfolio going into the weekend. So what do? They look into hedging, right? And that's probably number one for a lot of people going out there trying to avoid some weekend risk. So now your options, what do you have? You have effectively some longer term stuff. That's not really going to work for you for the weekend. It's not going to give you that gamma you really need to hedge it. So you're going to have to go near dated, not even really a month. You're probably going to have to go out into the weeklies for a couple of reasons. First off, you want that gamma to really kick in. So something does happen over the weekend. You want to have something that's really going to kick in for you. So near dated weekly, slightly out of the money SPY put is the way a lot of people like to go. Pros to that, of course, if you get that shock to the system over the weekend, assassination attempt, whatever the heck is going on, you are going to get a nice little pop in that put on the open on Monday. You're going to have vol popping, you're going to have the S&P selling off. It probably will work, but that's going to be very few and far between. Most times you're going to do that, even if you try to time it perfectly. So you're buying right near the closing print on Friday, you're opening and selling it right on the opening print on Monday. So all you're really trading is the weekend risk. You're not doing any intraday nonsense. You're still going to get hit pretty badly with slippage. Obviously, you're going to have to trade off the spread. So that's at the very least going to hit you. And it's probably going to be a little bit of price action, a little bit of movement in there as well. So slippage is going to come back to bite you. And so most of the data you're seeing on this, and again, it might be fun to, next time we bring Matt back on, he's the king of the back tests, to have him crunch some real world numbers for you folks in terms of going back over time, how something as simple as buying a SPY, let's say 5% out of the money put on the close on Friday, dumping it immediately on the open on Monday, how that works out. I've seen a lot of data. I've done some of this myself where I could say pretty reliably that it's not that great, but it might be fun to have some exact numbers. Maybe we'll look for that for a future episode out there. So your first probably go-to strategy for doing this, and if you're really worried, you could certainly spend that money. Just be prepared that whatever you spend for that SPY out of the money put right now, most, if not all of that money, probably going to go the way of the dodo. Dan, what are your thoughts on attempting to hedge weekend risk with a weekly, let's say, SPY or SPX or Q put, sir?
Yes, you can. I do like that intermittently, certainly not just buying put every Friday, especially because that does it's the cheapest. I mean, you buy an option on Friday that expires Monday, it's going to be the cheapest option you can get, but it's also going to have the highest theta. So if you do that all the time, it's not necessarily the best play. But, there's one thing that can kind of come into play, and it's not quite as good or as perfect, but does have some merit, is that, now SPX has extended hours, and they start trading, if I'm not mistaken, and somebody can correct me if I'm wrong, but I believe they begin trading on Sunday night at 7:15 p.m. So I mean, something's happened Saturday morning. I don't know. The fix is kind of already in, I think, but that could provide some value as far as hedging goes.
Yeah, and I should point out as well, when I'm talking about weeklies, I should mention it's not just the Friday expiration everyone assumes now. We talk about 0 days, and whenever I say 0 day, the exchange people always bristle and they write into the network saying they're not 0 day, they're listed ahead of time. And that is true. So you can go out, for example, and buy the SPY put or SPX put expiring on Monday. You could buy it ahead of time. You don't have to trade it all the same day. So you can go that route as well. You're going to be impacted by the same slippage issues that are going on out there as well. But so this is, again, not something I would say you can go out and do week in, week out and really repeat. It's not a rinse and repeat type of strategy because it's going to cost you a lot of money. This is really more for a weekend, maybe like last weekend where you were a little bit worried and you were feeling like you might be feeling some heat on your portfolio, in which case you're okay spending a little bit of cash on a near date. Again, if you don't want to spend for the full week, I understand that. You could just do the expiring on Monday option and buy it on Friday. Let's look ahead to some numbers here on SPY. And obviously, we're recording this on a Wednesday, so not on a Friday, looking ahead to a Monday, but we can somewhat approximate that. Looking here right now on Wednesday, if we look ahead to Monday's prices right now, S&P is at a 543. So, and SPY, so we're looking, let's keep things round numbers. Let's go down to about the 530 hand. That's where we want to hedge. That's a little over almost 2.5% out of the money. That's a fair level, I would say, for a little bit of weekend risk protection in your back pocket. Obviously, you're not super tight, but you're protecting against the worst coming to pass out there. So 530 in SPY. Right now, that option's trading around 44 cents. Obviously, it's Wednesday. If we roll the clock ahead to Friday, buying that for the option that expires on Monday, it's going to be cheaper, probably somewhere in the 20 to 25 cent range out there. So it's up to you. Again, all things being equal, SPY staying at this level, we're just rolling the clock ahead a couple of days. So it's up to you whether you think that's worth it. Now in my UVIX example, that's about how much I actually lost. If you bought 10 of these, that's $250. That's about how much I lost on my 1,000 lot of UVIX underlying. So it can happen either way, but just as long as you're okay with that money effectively being thrown out the window, because on the opening print on Monday, you might be able to recoup maybe a dime of that or something along those lines, but not much. So just bear that in mind, that a good chunk of that money, whatever you spend on those puts, is going the way of the dodo. If you're okay with that, that helps you sleep at night, then again, it's not an onerous amount. It's not something that is completely out of the question. I don't think you want to do it every weekend. That would become onerous fairly quickly. But if you have weekends like last weekend where you're looking out there and you're starting to say, well, maybe I'm a little bit uncomfortable. If this helps you sleep at night, in this case, $250 to hedge 1,000 shares of SPY, if that's worth it to you, and again, everyone's calculus is different, then that is one way you can go about it as long as you're comfortable with most of that money going the way of the dodo. Dan, the next one, some people might be saying, kind of the corollary to buying the SPY or SPX put is buying a near-dated, probably weekly VIX call as well. Now, the VIX calls, I've always said, people who think of them as a hedge, I bristle at that. VIX, and let's start there really quickly, Dan. When I say to you, VIX call is a hedge, do you agree or disagree?
Well, I would say, as a great man once said, but what is the definition of is, Mark?
Are you quoting Bill Clinton to me?
Because, it is not a hedge if is a very rigid word. It is not 100% hedge. Like buying a put is, well, a lot more like 100% hedge. I mean, it is 100% hedge, just that you pay for. But a VIX call is, probably a pretty good hedge, but not is a hedge. The last figures that I saw, and they could be a little different by now, they do fluctuate over time, is that the S&P 500 and the VIX are negatively correlated about 80% of the time. So that means 20% of the time, your hedge don't work, which is kind of a, kick in the kahunas. So I don't know. I mean, I know some people who make a pretty good business out of hedging with VIX options, but it is not an exact science, and it's not even an exact science for the experts. But if you're not an expert, I would say don't do it. I'm bristling right there with you, Mark.
You're bristling alongside my bristling. Yes, this is, I bristle at it being called a hedge because it's not. You're right. At the end of the day, the only contractually guaranteed hedge, the only contractually guaranteed inverse correlation is a put option. So if I was going to do something like this, if I was really concerned about something happening right now, I'd probably go for the SPY put. If I wanted something more concrete, if I'm a little bit more nebulous on what I'm concerned about, maybe I'm concerned about really the rug getting pulled out from under the market. We're seeing a more aggressive pop involve a more aggressive sell-off. Then you can go the VIX call route. Again, you want to keep it fairly close to home. You don't want to go out too far on this. So you're going to go in the weeklies at the most, I would say, out there. And again, you're going to go slightly out of the money because you want that gamma. You want something that's going to kick in. Now, for VIX, obviously, we have a little bit different game going on. VIX options obviously expire on Wednesdays. So you have weeklies, but you don't have the Monday through Friday slew of expirations the way you have in the S&P. So you can't come in and just buy that Monday expiration call in this case, if you were so inclined. So right now we're recording on Wednesday, July 24th. If I want to go buy some upside hedges in VIX, I have to go out a week to July 31st. And so obviously we're recording at a bit of a rarefied time. VIX cash just hit 18. So we're popping a little bit today. We haven't seen a VIX move like this intraday in a little while. So it's going to skew, pun intended, some of the numbers I'm going to throw at you here, listeners. But if we go out a full week, now obviously you wouldn't be going out a full week on Friday. You'd be going from Friday to Wednesday. And you could obviously close it on Monday. But just bear in mind, here's some of the prices we're seeing real world right now. With VIX cash at an 18, again, you have to look at the futures to really know what's going on in VIX options, but VIX cash gives you a sense at 18. We're looking at the 22 calls, so 4 handles out of the money going out in a week. They're offered at about 43 cents right now. So if you go 23 calls, they're at about 36 cents right now. So you're still talking more money than we were just talking about for the SPY puts. And you get a little bit more time, obviously. You're getting pretty much a full week here. So if you fast forward to Friday and you're only going to hold it through Monday, it's going to be a lower price. You're still going to have a lot of slippage, but you might be able to salvage, again, maybe a dime of that, what you buy on the close on Friday and selling on the open on Monday. There's usually a little bit of a bid left in VIX call. So all of that 40-odd cents or maybe 30-odd cents whenever you buy this may not go the way of the dodo, but it could. So just bear that in mind. You have to be comfortable with any of these trades. You have to be comfortable with most, if not all, of what you're trading going the way of the dodo, which is why, again, that UVIX trade is interesting and or appealing for a lot of people out there. This is the first time in a while where we've had the rally in VIX and it's actually persisted past noon. Usually by this point of the day, we've had whatever move we're having in VIX to the upside, 1.5 points maybe, and then it comes right back down. You can just listen to our Vol Views show, look at all the email, voicemail we get on that show, the tweets. Man, I had VIX calls. I can't monetize them. That can't get out fast enough. So usually that's a challenge. So there's a lot of things working against you in VIX land on top of the things we pointed out with the SPY put, the slippage, all those other things. So if you're really concerned, you want something a little bit more concrete, definitely go for the S&P put. It's going to be much more what you're looking for. The VIX is more really kind of a flyer rather than just a hedge. And again, one of the other phenomenons that the VIX traders are trying to take advantage of is something we've talked about on our Volatility Views show for a while. It's something people really noticed most aggressively with the onset of the weeklies a few years back. And this is a thing that goes back to when Dan and I were market makers as well. Dan, when you were a market maker and you were heading into a weekend, let's say, or a long holiday weekend, what was the one thing that was on your mind? What were you trying to do heading into that weekend?
Get rid of that. Well, actually, basically trying to get flat, really.
Yeah, you were trying to get rid of your decay. You wanted to dump options so you didn't have to pay for that weekend, listeners. And so market makers haven't really changed. They don't want to pay for weekends, so they start taking that weekend out, quote unquote. They start dumping their options usually ahead of the weekend. If it's a long holiday weekend, they might start as early as, late Wednesday, early Thursday. So you see the vol starting to come in, people lowering markets, hitting bids on things going into that weekend for that exact reason. What happens is that, and we really noticed this aggressively in the early days, like we said a few years back, of the weekly options, is that starts to get overdone towards the end of the week. And you have people hitting bids on the latter portion of Friday afternoon, where really the weekend is already gone at that point. And if you're selling your options then, you're effectively giving away the weekend for nothing. You're selling those options now on Monday's decay level. You've already gotten rid of the weekend. So you're getting nothing really for selling it on Friday. So a lot of people took the opposite side of that and said, maybe it's worth buying vol on the close on Friday. And that actually was a decent trade for a little while, especially in the early days of the weekly options. Now with the advent of 0 day, we've seen a little bit more flux towards the end of the sessions heading into the weekend. So it's not quite as one-to-one as it used to be, but there still is a lot of data out there showing that in aggregate, vol tends to be sold fairly aggressively going into the end of the week. So people have experimented with interesting ways to try to capture that. And one way, Dan, that I kind of want to put out there for our listeners, this is, again, a little bit more advanced. This is more of an options 201, perhaps even a 301. So not for all of the listeners of this show. But Dan, our buddy, Mr. Russell Rhodes, a.k.a. the once and future Dr. Vix. You are familiar with him, are you not, sir?
I am. Good man. Good man.
He was just on our Option Block show, the live at SIBO on Monday. He's on my Vol View show with me every Friday. He's been whispering in my ear for a while, Dan, now that he's been back testing this new strategy, and it works amazingly well. You want to hear what it is, Dan?
I would love to.
All right. So he's been testing around with UVIX. And if that sounds familiar, listeners, this is one of these levered vol ETPs. This is a 2x VIX levered ETP. If that's a bunch of gobbledygook to you, go back to our volatility show we did not that long ago. We talked about a lot of the different volatility trading products out there. One of them is this UVIX. It is a levered 2x VIX product. The reason why I haven't really ever considered buying the underlying itself is because this is a levered VIX product. It attempts to replicate that position, and as a result, it suffers terribly from that roll yield we talked about before. And again, go back, check out those episodes if you're confused by these terms. So this product erodes aggressively over time. So if you buy and hold the underlying, it's like literally watching the sand drain through the hourglass, listeners. It can be painful for you. It's not a buy and hold product by any means. But he's been experimenting, Dan, with buying UVIX right around the close on Friday and then just selling it on Monday, right on the opening print. And what he found is that it actually works out fairly well most of the time. I say most of the time because there is a big caveat I'm going to get to in a second. But he's been back testing this and then actually trading it himself in his own account. And usually, again, getting back to some of that weekend effect, if it's a quiet week going into the end of the week, VIX and indeed UVIX usually get hit. And then through some of the machinations of VIX, usually you see an effect on the opening print for VIX where it's called getting the weekend back. The market makers readjust. They realize, we kind of crushed VIX maybe a little bit too aggressively going into the close on Friday. And the opening print is usually up, barring some other adverse development in the markets. The opening print for VIX on Mondays is usually slightly up. And that's, again, the weekend typically coming back in. So he's been trying to take advantage of that with this strategy by buying on the close, selling on the open, and has worked out. He's up a bit on this strategy. So he was whispering in my ear again, Dan, last week about this strategy. You have to try it. So I thought last weekend, what a better time to try it than then, right? We had very literal weekend risk. We had the strong possibility that the president may step down from his ticket. And so I thought this might be a good time to try it. So I was working some bids in UVIX, and I ended up buying UVIX at 612, right near the close. I was surprised. Russell actually bought it a couple hours earlier at 618. That's a lot more intraday risk than I want to take with a product like UVIX. I want to really do this as a purely weekend style trade. So I bought it pretty much close to the closing print. I talked my buddy, the Rock Lobster, on the Options Oddity show into doing it as well. So he bought it for 610. He got a little bit better fill than me, the bastard, right at the end of the day. So we both got into it. I was at the summit on Monday there. I was talking to Jim Carroll at Fixologist on Twitter. He also bought some UVIX. A lot of people had UVIX in their back pocket this weekend. And then what happened, Dan? The news comes out. Biden announces he's stepping down on Saturday. No real announcement of endorsing Kamala Harris there. That was still to come. So everyone thought, okay, well, maybe we're going to get some juice out there in the vol. And of course, the opening print comes on Sunday. And what happens? Market's up. Vol is getting annihilated. And this is one of the few times in all the times that Russell has been trading and tracking and back testing this strategy, Dan, that it lost, and it lost hard. So I ended up dumping my UVIX. I got out right away because, again, UVIX, it's kind of like liquid napalm, listeners. It can explode, it can be fiery, but it's also going to just run right through your hands and burn on the way down. So you don't want to hold it. If the trade you have is not working out, you want to get out of it right on the open because it's only going to erode. And that's exactly what happened. I ended up bailing on it right on the opening print around 585. I think it closed on the day below 5.5, maybe a 5.25. It got annihilated. So this was, of course, the time everyone dove into this trade, Dan, and it's the worst performance it's had yet. So when I saw Russell on Monday, he's like, "Are you going to kick my butt?" And I was like, "No, I'm fine." But it was kind of funny. Everybody gave him a hard time because he talked us all into this trade. So I want to point that out to you. It's not a foolproof strategy by any means, listeners. And there were some aberrant conditions this week. UVIX and vol actually went up going into the close on Friday. So sometimes if it's overdone, they might be taking the weekend back out on Monday. Maybe they think they overdid it on Friday. And so the event happened. They're not concerned anymore. They're taking the weekend, the ball out. That's exactly what they did on Monday. Of course, they're bidding it back up now. So if you had held UVIX for a few days, which again, I don't advocate at all, then you would be doing all right. In fact, I think it's back up to close to unched where I had it from Friday. So it takes this kind of Herculean move to lift UVIX again. That's how hard it is to get going on that product. But that is one thing to keep in your back mind to experiment. Even that, I joke about getting hit. I bought 1,000 shares at 612. I dumped them at 585. So $270. It's not expensive. It's not cheap, but it wasn't the worst. If you buy options on most of these products, all that money is gone anyway. So it's just one other thing to float out there. Dan, what are your thoughts on using a product like that to try to play the weekend risk game in VIX and try to get a free or a low cost bite at the apple for hedging your weekend risk?
That's pretty interesting. That is a phenomenon that I observed, a long time ago. I've done webinars on that probably a decade ago about the weekend effect on VIX. Because, basically I don't think you touched on exactly it. If you did, I missed it. But what Mark's talking about is like the VIX calculation is like, a bunch of numbers on a piece of paper. Not really. It's electrons on a server, but they don't know that the market maker, the model is not a person, can't think. It doesn't know that the market makers are taking the weekend out because they don't do it at the same time every week or anything like that. So all the VIX calculation knows is that the VIX options are getting cheaper. And so if the VIX calculation was a person and could talk, it would say, oh, options are getting cheaper. The VIX must be lower. Let's make me lower. But then on Monday, when the days are on the right number of days, which is the same number of days they were on Friday, but it's 3 days later, then the VIX looks a lot higher, and that's the effect that Mark's talking about. What would be interesting, Mark, as you were saying this, I wonder if a further study, postulate or whatever you want to say, would be to look into the option version of it. I wonder if the volatility of volatility has any impact over, from Friday to Monday. Like, would it be better to buy the shares or buy the calls or sell the puts?
Yeah, I thought about that too, and I did do some rough workshopping of that as well. The problem with UVIX is it's getting better, but it's still not the most liquid of products. So you're going to get hit on slippage on that. So that's the problem. The ADV is growing. It used to be sub 10,000 a day, 5,000, 6,000. It's getting up north of 10,000. It did 20,000 one day last week. So it's getting better. That problem is mitigating, but it's not quite there yet. It's not like, at the money SPY where you could kind of get in and get out, and you're going to have some slippage, but you can usually do all right. With something like UVIX, you're going to have to lift offers and hit bids, and it's going to be painful. So that's I did think about that as well first, because that's usually my go-to. I don't want to touch this UVIX underlying. It's toxic poison, right? But the reason for that was because of the slippage. If the liquidity improves, that might be an interesting way to go about it. But yeah, that's something I have been mulling over as well, and maybe we'll add that corollary to the list of back tests. Maybe we'll add that to the homework we're going to give Matt for a future show. Maybe Russell have him back test the options. But I'm looking at it right now. The liquidity is still not there. But an intriguing idea nonetheless. Before we run out of weekend risk for this week, any other ideas or strategies or just tips and tricks you want to share with the folks, Dan?
Geez, man, we covered a lot. No, I mean, that's good. If I think of anything else, it'll probably be enough for a whole new episode. So might as well hold off.
We'll save it for then. As we keep on rolling, listeners, it is time for the Market Taker Question of the Week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. P, the people have been waiting with bated breath all episode. The floor is now yours for, as you promised, your 25-minute Market Taker Question Spectacular. Have at it, sir.
Yeah, this came up just recently. When do you use a broken wing butterfly? You can do iron condor versions, et cetera, et cetera. But for this, we'll stick to the butterfly. So when would you use a broken wing butterfly? And for me, there's two reasons too. One is just by necessity, like you want to do a regular butterfly, but the strikes aren't there. Like, maybe the stock's at 100 and below 100, they're $2.50 wide strikes. Above 100, they're $5 wide strikes. And, you want to do 250 wide. So you do that on the put side, but you do $5 wide on the call side. There's one reason right there. And that's just out of necessity. I want to do it a different way, but I can't. But then the other way is, when one side is wider, you get less risk on one side, more risk on the other. So, the intentional way to do it, where it's not just by necessity, but like actually desiring to do it, is when I'm less worried about, say, the downside risk, but I'm a lot more worried about losing money if the stock goes up too much. Then I'll rejigger it so that the top side has a lot less risk if it goes against me, and I'll accept more risk on the downside. So there you have it. That could be a whole episode as well.
All right, there you have it indeed for this week, listeners. A fun run through on some potential ways to tackle weekend risk in your portfolio. Some of them you probably don't want to hear, like scaling back or getting out of your position entirely. I do think for a lot of you out there, these, again, people don't like them, but if you're really concerned about weekend risk, the 0-day does, and the weeklies as well, do offer that option, pun intended, to avoid it, do an end run around it, trade whatever you want to trade without having to worry about the overnight or the weekend risk. Some of the other more widely touted things like your SPY puts and your VIX calls, going to be challenging, going to be a lot of slippage. It's going to be losses every time you do those, and depends how much of a loss, if you want to let the whole position go to zero or not out there. If you're just trying to do it close to open, you're still going to have some pretty heavy slippage on those. Again, the UVIX one, the jury is still out on that. Obviously, it didn't work that well this weekend when there was quite literal weekend risk. But it is an attempt to solve that problem. I think as the liquidity improves and some of the options on these products, that might be a better way to go. We'll see. Again, you're trying to play, and what I was banking on with that trade really was that weekend effect really kicking in on VIX, and at least on the opening print, giving us a chance to get out. Turned out to work the opposite way this time. They took the weekend out that they had added aggressively. You don't see that too often. But intriguing stuff nonetheless, and probably a topic we will explore again on future episodes. If you have a way you're dealing with weekend risk in your own portfolio, could be the broad index, could be single names you're dealing when you found an interesting, effective, or just something that makes you stroke your chin and say, thing about weekend risk you want to share with us, you know where to get at us. At Options on most social media platforms. Questions at theoptionsinsider.com. Also works, of course, if you're on the Pro, you can hit us up there as well. Just go to theoptionsinsider.com/pro if you want to learn more about all that fun. And Dan, where should they go if they want to learn more about all things to
Yep. Make your way on over to markettaker.com, 2 T's in a row, and join free, join our chat room, ask me questions. Any way we can help, I am glad to do whatever I can.
There you go. Check them out, Market Taker. Don't forget the second T for Theta. And while you're checking things out, make sure you're checking out public.com. That's the place to go to kick the tires and light their fires on their brand spanking new options platform. Try out that rebate. Let them know what you think of it. Let them know what you think of the rest of the platform. By all means, let them know you heard about them from us. It goes a long way towards supporting this show that you've been listening to, hopefully for a very long time, even though we know we have a lot of new listeners all the time. Welcome to all of you folks out there. That's going to do it for us on the network today. Back again tomorrow with our usual doubleheader on Thursday of the option block, as well as This Week in Futures Options. Friday, of course, another doubleheader. Vol Views at noon. Who's going to join us to talk Vol? You got to tune in to find out. And then after that, exclusively for our pro folks, we come back one final time to round out the week, talking all sorts of unusual activity on options oddities. Again, theoptionsinsider.com/pro is the place to go to learn more about that. Then we head on into the weekend. How am I going to hedge my weekend risk this week? I guess we'll find out on Vol Views. Then we're back again on Monday with the option block and crypto rundown all the way through to next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.